The shutdown drags into a second week, but what is it costing the US? This is Macro Matters, and we're talking the shutdown. The US government will remain closed into next week as lawmakers have so far failed to reach agreement, and it's hard to assess its impact on economic data because the federal agencies that release those numbers are also shut. The September jobs report hasn't been published, and if the shutdown carries on into the middle of next week, key inflation figures will also be missed. Odeta Kushi is Deputy Chief Economist at First American. Odeta, this has been going on for 10 days. Is that already enough to see some economic impact?
I'm sure those inside the Beltway are feeling it, but typically we don't see a huge hit to the economy or at least to GDP. Of course, that really depends on how long the shutdown lasts. And a lot of those that is lost is ultimately regained when the economy reopens.
Federal workers, of course, are furloughed and aren't being paid, and President Trump has been threatening to cut some of their roles permanently. Could that be on a scale that would affect the wider jobless rate?
If those layoffs do occur, I think that does pose a greater risk to the broader economy, to consumer spending, to confidence. It's not yet clear if that will be the case, but certainly layoffs is an escalation and could threaten the economy further.
Without official data, of course, neither economists nor the Fed really know what's happening in the US labour market, but do you think it's weakening?
I do think there's been a broader cooling trend in the labour market, and we can see that in the private sector data as well. Certainly, this makes the Fed's job a little bit more difficult heading into that October meeting because they don't have these data sources to look to, that key jobs report, and perhaps even that CPI inflation data. They can rely on private sector data, and the market still expects a rate cut in its October meeting precisely because a lot of those aggregate data sources are showing a broader cooling in the labor market.
Do you think the lack of information is going to make Fed policymakers feel more cautious, though?
I do think that they'll approach this next meeting with more caution, not having a full picture of what's going on in the economy, but markets are still anticipating that rate cut, and I really do think that comes back to the labor market story. I think the Fed is trying to prevent a job loss recession, and so far the 2025 data has decidedly shown a cooling labor market.
What about the interest rates on government bonds, which feed, of course, into mortgage rates? What's that market telling us about how much political uncertainty worries investors?
Not too much movement. We've seen that 30-year fixed-rate mortgage come down a little bit. It's at about 6.3% today. And it's moving the needle a little bit on housing demand. That slow decline in mortgage rates is getting some buyers off the sidelines, but not a ton. And it's important to keep in mind that when buyers are making that ever so important, that lifestyle and financial decision to buy a home, it's really predicated on consumer certainty, and a lot of this is adding additional uncertainty.
If this drags on for longer, then would you expect it to have more impact on American borrowers and potential home buyers?
I do think that the longer the shutdown lasts, the higher the risks to Main Street and mortgage markets.
That was Odeta Kushi of First American. Don't forget, you can watch more videos on Reuters.com.